It's no secret that we are real estate investors, and a large portion of our net worth is tied to real estate. So it only made sense for us to put together a whole series dedicated to investing in income-producing rental properties. We're thinking of making this a 4-part series where we break down our process, our mistakes, our successes, and of course, how you can become a real estate investor yourself. All that being said, let's go ahead and get started. Hey guys, welcome back to our channel. We're Alma, Jerwin, and Chopal. We're 2 Asians and a dog. As you guys know, we have been investing in real estate for several years now. If you're interested in how we got started in investing and our rental income, check out our video, How Much Money Can You Make from Rental Properties? In that video, we share 3 of our rental properties and our numbers. We talk about how much we bought our properties for, our down payment, the rehab cost, and of course, how much we've earned passively through our rental properties. Another crucial information that we share in that video is how much our rental income increased over the course of owning the properties. We'll have that link in the description box below. Having an investment property can yield years of reliable rental income if it's done right. Now, financing an investment property is a little bit different than getting a mortgage for a primary residence. So let's talk about some of those differences and what you need to get ready.
So first, you need to know your credit score and your credit history. And we are assuming you watch our video we posted a couple weeks ago, how to boost your credit score fast. We'll link that below also. When it comes to borrowing money from banks and lenders to purchase a property, having an excellent score will not only allow you to borrow money, but it will also allow you to save a lot of money. Being a responsible, trustworthy borrower means that the bank will give you a loan or a lower rate on your loan.
Your interest rate when financing an investment property tends to be higher compared to a primary residence. Your rate could be 0.75% to 1% or more on an investment property. Having an excellent credit score will keep your mortgage at the lowest rate possible, which is crucial to your cash flow.
Now, qualifying for a loan is obviously not just based on credit alone. You must have a strong job history and a good DTI, which stands for debt to income ratio, which essentially means you don't have a ton of debt. Debt such as your credit card balance, your auto loan, your RV loans, or even your personal loans. Also, if you are a W-2 employee, you must be in the same field for at least 2 years. Of course, there are other factors, but these are the major ones that most lenders look at.
Like Jerwin said earlier, your job history has to be the same field. You don't necessarily have to work for the same company for 2 years, but you have to be in the same career field. For example, in Las Vegas, if you work for one of the casinos as a restaurant manager, you can quit that job and move to another casino as long as you're still in the same food industry. It counts towards your 2-year job history. Lenders or banks like seeing 2 years because it highlights job stability, and for them to lend you money, they need to make sure you're stable and you're able to pay them back.
Now, what if you're self-employed? Well, that's currently us. Before we became self-employed, we were the perfect borrower. We were both W-2s. We were both at our jobs for over 4 years, excellent credit score, and no debt. Then we became self-employed, and we became the problem borrowers. We still have excellent credit and no debt, but going from W-2 to a 1099 was such a pain in the butt. Seems like they asked for twice as many documents, letters, and explanations about everything for the lenders to qualify us.
The number one advice we can offer for anyone that's self-employed is to make sure you have an excellent accountant or CPA. Our CPA knew our plans ahead of time, so we structured everything so we can be lendable. If we didn't create a plan, we honestly probably wouldn't be able to be in a position for any lenders to approve us for a loan. In our second video in this series, we will cover why having a CPA in your team is so crucial.
Having an emergency fund, or sometimes we call it a lifeline, is one of the most important things to have while going through this process. Most lenders will require you to have a large reserve when purchasing an investment property. Typically, you'll need at least 6 months of mortgage payments in reserves. Now, this can be an emergency account or in combination with your existing retirement accounts. Now, we advise you guys not to invest in the stock market without first having an emergency account, right? Well, this applies to purchasing to real estate as well. Do not, I repeat, do not purchase your first investment property without having an adequate emergency fund. There are just way too many uncertainties and question marks when purchasing your first investment property. 10 out of 10 times, you will need more money than you think you'll need. Having a safe cushion to fall back on is paramount.
Okay, so once you have your credit and finances in order, let's move on to what you'll need after finding your investment property. You not only need your down payment, say 20 to 25% of the sales price, but you will also need 1 to 3% for closing costs. Closing costs can vary from state to state, and it also just depends on the contract you agreed upon with the seller. Those expenses are just for the loan aspect of the deal. We still haven't even covered the expense for after the property is yours. We won't focus on choosing the right property in this video, but we will cover that in a later video. Regardless which property you end up purchasing, you will have some kind of after list. We recommend that you purchase a somewhat move-in ready property for your very first deal. We don't recommend purchasing a rundown property that needs a lot of work. Ideally, your first property may just need minor work, such as replacing the carpet, new interior paint, and possibly a few fixtures to update, such as a new faucet, ceiling fans, and maybe a few doorknobs. We feel that smaller projects aren't as scary to tackle if you're a beginner investor, unless you have the experience or you enjoy a good DIY project.
Let's tie this into the importance of having an emergency fund. While you'll need to have the funds for the down payment and closing costs, you also have to remember that you'll need additional funds set aside for the items we listed earlier for your after list. Say you budgeted $5,000 for minor repairs and upgrades, Elma mentioned earlier. The ceiling fans, faucets, and other small fixtures. Well, from our experience, you may want to double that budget. So if your budget was $5,000, now it just became $10,000. Even though our intent is just to update the property a little bit, you will undoubtedly encounter additional items that you didn't even factor in, hence we recommend increasing your budget. Not only will you add additional projects, which in turn will increase your budget, you may also encounter certain projects you don't feel comfortable doing, and will end up hiring someone to do it. For example, we mentioned on one of our videos, Save Money Fast, Part 2 I believe, I personally do not touch anything electrical. Whether it's changing a light switch, installing a light bulb, installing a ceiling fan, I just don't feel comfortable and would rather not put myself in a position to get electrocuted. So how much down payment do you need to purchase a rental property? To determine this, let's go over the percentages required for each loan type and the pros and cons.
There are several loan options to consider when purchasing your first investment property. We say loan because even if you have cash may not necessarily be the best option, especially since interest rates are so low. They are practically giving away money. Leverage is key when it comes to real estate. The most common loan option is an FHA, conventional, or a VA. A VA loan is for people that served or is currently serving in the military in some capacity. One of the main perks of this type of loan is that you can purchase a property with no down payment. Of course, there are other perks, but having to put down $0 to buy a property is huge. The credit score requirement is in the range of 650 and above, but it could range depending on the lender.
FHA is typically common for first-time home buyers. The minimum down payment for this is only 3.5% of the sales price of the home. Credit score requirements is a little bit more flexible. It's around 580 or above, which again can vary depending on the lender. Now, having an FHA loan means you have to have PMI, which stands for Private Mortgage Insurance, which essentially means that if you're buying a property and you put less than 20% down payment, you'll have to pay additional insurance. Before April 1st, 2013, once you have 20% equity on your property, you can request for that appraisal, and if you have 20% equity, your PMI will be dropped off, which in turn lowers your monthly mortgage. After 2013, that is no longer an option whatsoever. If you do an FHA loan, the PMI is now on the loan forever. So let's say if you keep the property for 30 years, you'll be paying that PMI for 30 years. PMI is 0.55 to 2.25 of the original loan amount per year. So that means it goes down every year. This could be several $100 every month depending on the loan size.
PMI is applied on FHA loans because the down payment requirement is lower and the lenders feel that an FHA buyer has a higher chance of defaulting on their loan. Therefore, they charge the PMI as protection.
We recommend doing a conventional loan as a brand new investor when purchasing your first investment property. You can put down as little as 5% for a conventional loan, which with some lenders and banks. One of the biggest difference between an FHA and a conventional loan is that the PMI. So with a conventional loan, the PMI will drop off after 20% equity on your property. However, you will need to request an appraisal to prove that equity is over 20%. We have personally done this, I think like 3 years ago, and the whole process took about 6 weeks, and the bank sent out an appraiser, and magically the PMI disappeared because we had 20% equity in one of our properties.
With all that said, what we recommend is to put down 20%. Like we said earlier, having PMI will eat into your ROI. Having a 20% down payment, you can avoid the PMI altogether, which reduces your monthly payment and therefore increases your cash flow.
We also wanted to cover a few random tips we feel all new investors should know regarding the financial aspects of purchasing an investment property. Starting with limitations you'll encounter after you purchase your 4th property. For example, if you have one primary loan and let's say you have 3 investment properties, you'll be required to put 25% down payment on your 5th loan when getting a government-backed mortgage, which are the type of loans we just talked about earlier.
We didn't know this until we had no choice but to put down 25%. If we knew about this ahead of time, we would have approached our investment strategy a bit different. One thing we could have done had we known is by qualifying under one name on our rental properties. For example, we would have put 4 loans under Jerwin, then 4 loans under me, which is a total of 8 loans requiring only 20% down. Instead, we were both on just about every loan, quickly exhausting our 4 loans, and then we were stuck with putting 25% down on every loan.
Another tip is that after 10 government-backed loans, it becomes very, very challenging qualifying for your 11th one. Most banks and credit unions will no longer lend to you. This is where seasoned investors are using hard money strategies. Hard money is essentially private money, like you borrowing from an individual or even a group of investors. The rates and terms are typically higher. The lowest rate that we ever got quoted for was about 6%, but they typically range from 8 to 12% on the rates. One way to combat this is once you're, let's say, at 10 loans, start paying the loans down one by one, which in this case allows you to purchase a new property as an existing one gets paid off. Now, we know this series is for beginners, and thinking about having 10 properties is so far away. We just want to give you guys something to think about, because if you guys do this right, you can quickly grow your investment portfolio to over 10 loans really quick.
All right, guys, so we covered a lot in our first video series on buying your first investment property. This video was a bit longer, but we really wanted to make sure we gave you guys more details to help you when you're creating your business plan on how to grow and start your real estate investment journey. Everything we mentioned here, we have personally experienced and wanted to give you guys our best advice on how to avoid some of our mistakes. If you found value in this video, please support our channel by hitting that thumbs up button, and don't forget to subscribe and hit that notification bell so you'll be notified when video 2 goes live. Our next video will cover having the right team in place, and then video 3 is going to be about how to choose the right property and how to screen for the right tenants. And then lastly, video 4 will be about buying your second property and growing your real estate portfolio so that you can create the life you want to live. Thank you guys so much for watching, and we'll see you guys in our next video. Oh wait, we forgot about Showpal's tip of the week.
Showpal's tip of the week. If you guys have any questions regarding real estate and real estate investing, please shoot us a DM on 2 Asians and a Dog, or leave a comment below and we'll make sure to answer it in our future videos.